Hi, my name's Debra, and today I'm going to be talking about the new question on the 2024 Form 8854. For some context, Form 8854 is the information return that every expatriate must file. This gets filed with their income tax return for the year of their expatriation. And this form asks a number of questions to determine whether you are a covered or non-covered expatriate. And the 2024 version adds a new significant changes to assets and liabilities question in that section of the form. Now I put a little series of asterisks next to new because the question is new, but the requirement is not. And I'll show you what the old requirement was in a couple minutes. So, what I'm going to cover today: the old requirement, the new requirement, what seems to have changed from the old requirement, and some ideas about how to approach the question. So, a little bit of background information first. An expatriate is a U.S. citizen who gives up their citizenship, or a U.S. green card holder, which is a lawful permanent resident, who gives up their green card after having the green card during 8 of the last 15 years. If you fit into one of those two categories, then you're an expatriate as it's defined under Section 877 and 877 Cap A of the Internal Revenue Code, and those are the people I'm talking to today. Now, when you're an expatriate and you're giving up your citizenship or your green card, and you've had the green card for a sufficiently long time that you're going to be an expatriate, you might have to pay exit tax. And whether you pay exit tax depends on whether you're a, quote, covered expatriate. You're covered if you, quote, fail any one of these 3 tests. If your net worth is over $2 million, or you have a high enough 5-year average tax liability. For 2025 expatriates, the number is $206,000, but that number gets indexed for inflation. Or if you didn't file tax returns or pay taxes for the 5 years before your expatriation year, that's called the certification test. If you fail any of those 3 tests, then you're a covered expatriate. All other expatriates are non-covered, and if you're not covered, there's no exit tax. So these financial tests determine whether you have exit tax to deal with. And exit tax is a few different things. Primarily, it's a deemed sale of all your worldwide assets. You have this pretend event, you pay tax as if it actually happened, and that's your exit tax. There's a few situations that the rules are different. So for deferred compensation, there's rules for eligible deferred compensation, ineligible deferred compensation. Eligible, that's where you get 30% withholding pay as you go from anything you take out of that in the future. Ineligible is a deemed lump sum distribution. There's special rules for specified tax deferred accounts. That's actually a lot like ineligible deferred compensation, actually exactly like it. It's just a deemed lump sum distribution. And then there's rules for non-grantor trust interests as well. Exit tax is reported and calculated on the expatriation year tax return, and information is reported about the exit tax calculations on Form 8854. The other major impact of covered expatriate status is the Section 2801 tax on covered gifts and bequests. This is finally happening. It's been a law on the books for a long time now, but it wasn't until 2025 that a draft Form 708 became available, and final regulations were published in January 2025, and those point to January 1, 2025 as the effective date for these rules, having to actually finally follow them at this point. So 2 major things: exit tax and the Section 2801 tax, basically the For the Section 2801 tax, this is where the heirs or the beneficiaries, people who receive gifts or inheritances, U.S. people who receive gifts or inheritances from covered expatriates, have to pay a tax on that. So we have these two major things, exit tax and Section 2801. And so there's a good reason to avoid being a covered expatriate if you can. Common planning techniques. So of course, people who are planning to expatriate, if they can avoid being covered, they're going to do that. So one of the things they do is make gifts to reduce their net worth to avoid covered expatriate status. They make gifts of highly appreciated assets to reduce exit tax if they can't reduce their net worth enough to avoid being covered. They can at least make it so that when the exit tax event happens, they're paying less tax. Another common planning technique is selling or distributing assets to prevent double tax. That's a really common issue, like, for example, foreign real estate. If you own foreign real estate, you have an exit tax event in the US, you have to pay tax on it, but you don't get a step up in basis or any foreign tax credit in the foreign country where the real estate exists. So if you're a covered expatriate, you're going to have a tax on the pretend sale of that in the US, and later a real tax, a tax on the real sale in the other country. Double tax event. So sometimes people sell things prior to expatriation, so tax credits work the way they should and they don't have double tax. People also restructure to avoid US estate tax because the estate tax, the unified credit goes away when you're a non-resident alien. So US estate tax suddenly becomes a problem for former Americans. Another common planning technique is early transfers to heirs or planning for the kids to expatriate, because if your heirs are not US people, then they're not having to pay tax under Section 2801. So there's a lot of motivation for a lot of people to avoid covered expatriate status or to do other structuring to make their situation better in terms of either exit tax, Section 2801, or both. So in 2024, a new question has appeared on Form 8854. It's in Part 2, Section A. It's Question 3. I have it highlighted on the screen here. Have there been significant changes in your assets and liabilities for the 5 years ending before the date of your expatriation? See instructions, and you check yes or no, and if you check the yes box, you have to attach an explanation. So let's take a look at the old requirement first. This existed in the past. There was no question on the form, but buried in the instructions, I don't remember what page it was on, there was this little paragraph. Note, if there have been significant changes in your assets and liabilities for the period that began 5 years before your expatriation and ended on the date that you first filed Form 8854, you must attach a statement explaining the changes. Now, this was the only guidance that existed. There was no explanation of what significant changes means, what the statement should contain, what an explanation consists of, just no guidance. This is all there was. So I've been following this rule for a long time in the Form 8854s that I prepare. I can't remember ever preparing any without at least considering whether this question required a statement on any particular Form 8854. So as long as I've been doing this, I've been following this rule. However, because of the lack of guidance, how I responded to this question kind of evolved over the years. And I'm not going to go into the specifics about that really, but let's just take a look at what this really says. So we have a time period here, beginning 5 years before the expatriation date and ending with the date Form 8854 is filed. So for example, if you have an expatriation date January 10th, 2023, and Form 8854 is filed on November 20th, 2024, because there was an extension to December 15th. Then the time period that you're looking at starts January 10th, 2018. That's 5 years before the expatriation date, and it ends on November 20th, 2024. So it's a long period. That's about 6 years that you have to look at for whether this person had significant changes to their assets and liabilities. Now, under the new requirement, we get 2 paragraphs instead of just 1 paragraph. And this gives a little bit more explanation about what you have to do and how you determine if this applies to you. So I'm just going to read this. Check the yes box if there have been significant changes in your assets and liabilities during the 5 years preceding your expatriation date. If your net worth was $2 million or more at any point during the 5 years preceding your expatriation date, but was less than $2 million on your expatriation date, there have been significant changes in your assets and liabilities. You must attach a statement to Form 8854 that explains the changes. Then it gives an example. During the 5 years preceding her expatriation date, Maria's net worth exceeded $2 million. However, after Maria made a gift of real property to her child on October 31st, 2024, Maria's net worth decreased such that it was less than $2 million on her expatriation date. Maria reported the gift on a federal gift tax return. Maria must check the yes box. Maria must also attach a statement that explains that her net worth decreased because she made a gift of real property to her child on October 31st, 2024, and that she reported the gift on a federal gift tax return. So, buried within this is some form of guidance emerging. I would not say yet that we have clear guidance that covers exactly what we're supposed to do, but we have an example and we have a description of what, one thing that qualifies as a significant change to your assets and liabilities. One thing I want to point out is that the time period we look at here is different. I don't know if this is on purpose or not, but previously, with the years 2023 and before that, the time period you looked at for the significant changes was starting with 5 years before your expatriation and ending with the date you first filed Form 8854. Now it's only during the 5 years preceding your expatriation date. So this seems to cover less time, and it does not include the time period between your expatriation date and filing Form 8854. We also have a little bit more specific guidance. They describe significant changes as if your net worth was more than $2 million, and then it decreases to less than $2 million by the time you expatriate. But it's not clear what other situations might qualify as significant changes because that term is still not defined. They also give you a specific example. Maria gives real estate to her child and files a gift tax return to report the gift. So she has to check yes on line 3, explain in a statement attachment that her net worth decreased because she gave the real estate to her child, and she has to state that she filed a gift tax return to report the gift. So we can extrapolate that guidance to real life situations. Okay, let's say I have a client and he gave away some stocks to his spouse before he expatriated. And maybe that gift was not reportable on a gift tax return because the spouse was a U.S. citizen and it qualified for the marital exemption. So in that situation, we would explain that net worth decreased because of that gift and that a gift tax return was not required. But what about other situations? We only have guidance on this one situation. So again, a gift where a gift tax return is not required. As I just explained, I think that situation still counts as significant changes because the change happened whether the return was required or not. What about a transmutation of community property? In community property states, where spouses take their 50% undivided interest and assign their property so that each spouse owns an equal amount, but each spouse owns specific property. Is that a significant change? I'm not sure. What about a divorce in the 5 years before expatriation and the marital property distributed according to a divorce decree? I think that might count. I've had a situation where a client was divorced in the years leading up to expatriation, and we did disclose it under the old rules. And there's no further instructions or examples beyond the one given in the 2024 Form 8854 instructions, so we're still kind of just figuring out what we think might apply. It's left to us as practitioners to kind of imagine what we need to do here until we get more guidance. Now, I think it's important to highlight what's common to both the old and the new rules. First of all, significant changes is still not defined. And I think it's really important for us as tax preparers, practitioners, to insist that this is not a definition. What we have is an if-then statement that says if this occurs, then there's a significant change in assets and liabilities. But what if somebody's net worth changes by $40 million leading up to expatriation? It just doesn't happen to make them a non-covered expatriate. Isn't that pretty significant? So we don't have any sort of, how do we look at what significant means? Is it only significant for the purpose of this test if someone would have been covered, but then they're not covered because of some change? I don't know. Also common to both the old and new rules, there is no specific format for the statement attachment. It's kind of a free-form statement, and there's no clear requirements on all the information that must be provided. Again, it's just an example that kind of helps us, but it doesn't give us clear guidance. And then lastly, the statutory authority from this still comes from Section 6039, Cap G, B7. The IRS has the right to request any such other information as they want on Form 8854, and because that code section exists, we have to just follow what they ask for on the form, if we can figure out exactly what that is. So, in summary, we have some more guidance, I would say just a tiny bit more, from the IRS on the requirement to provide information about significant changes to assets and liabilities. There seem to be some changes to the time period reporting, maybe inadvertent, I don't know, it kind of seems like that wasn't necessarily on purpose, but I don't know. The IRS seems to want to capture situations where someone avoids covered expatriate status who otherwise would have been covered. And I want to leave you with a question today. Is this a gotcha? I don't know. I don't really think it is. If you make a gift and you transfer all the rights and benefits and risks of ownership to the new person, and it's reported on all the necessary forms for the IRS and any other local or foreign governments, and let's say you transfer real estate and the deed is transferred to the new owner, and the new owner decides whatever they want to do with it, they can do, and you don't have any say in that. And any income from the assets gets reported by the new owner, and there's no sort of backdoor agreements that they're going to give it back to you, then it's a gift. So it can't be that the IRS is saying that you suddenly can't make gifts, which seems to be what some people's fear is. So as long as you follow all the good practices, the standard practices for making gifts real gifts, you can still give away assets to plan for expatriation. But it does seem to be just an expansion of information gathering and maybe just bringing things to the surface where people make mistakes. I don't know. Like I said, I want to leave you with that question, something to think about, something to talk about. If you want to reach out to me, please do so. My contact information is on this last page. And just a reminder, this presentation is not legal or tax advice. Don't use it to avoid penalties. I'm not providing advice to you just because you're watching a video on YouTube. Please hire someone to help you. Thanks, everybody. See you next time.